Thank you for joining me today. I look forward to this conversation because we've got a lot to talk about. And let's talk about the first thing. We'll make it broad about geopolitics and the tensions around the world, the shifting dynamics with China, energy security, domestic security, cybersecurity, all these things that are driving kind of the market action. Give us a little sense on where you think we are in here, and then we'll take it from there.
Perfect. I'll give that a go. It's one, it fits my firm very well.
It's like globalization is the theme that's going to be there. And what we are advising clients is that make sure that you have your portfolios, take advantage of that. Really important, like if you're investing in the S&P 500, you're hyper-focused in a lot of the tech companies. Make sure that you have that global exposure. Within globalization, we like countries like Japan, which have gone through a lot of corporate governance changes. Mexico benefits from nearshoring. So we are guiding our clients to be able to have a solid exposure in the global markets.
Are you overweighting either a sector or a country?
So we typically we keep about 15% of our portfolios in the international markets. We get exposure basically through ETFs, a lot of it.
Right.
We would get the IXUS, which would give you the broad exposure. But then we have the Japan ETF for specific exposure because we like Japan. And then we have the Mexico ETF for that exposure.
Do you have Chinese exposure as well?
Yes, we get the Chinese ETF as well. We think it's for us, we do think that it's a key component of the global world, and we do want to have some exposure there as well.
You know what I think is interesting for a lot of people, because I had this conversation, a lot of people think China is in the developed market world and it's an emerging market, right? And so people are always laugh but it's so big. I know, but it's still it's considered an emerging market. It is not. When you think about the developed markets in Asia, it's not Japan, it's not Australia, it's not, right? But to your point, emerging markets are actually performing very well this year.
Emerging markets are performing great. And, I think that if you look at it from a historical perspective as well, the outperformance between the US and international markets tends to go in cycles. And now we are coming out of a long period of time where the US markets have outperformed, and now international markets starting from last year have started to outperform.
Right.
After the tech bubble burst, a similar outperformance, I think we're going to get into a similar type of a cycle now.
Right.
I'd be happy to add too. I think this, I believe really strongly, but to that moment, I think where
European markets are performing very well this year.
Yeah. And they're starting.
Spain, Italy, they're performing very well this year. I think they're up better than 20%.
And I think they'll continue because what you're seeing again is I think each country is going through this kind of vertically integrated nation kind of philosophy a little bit. And I think when Trump kind of kicked that hornet's nest on global trade, he expected, everyone will go and trade with the US. And I think so much has gone on. People are like, yeah, you know what? We have to do more. We have to be more independent with our allies, but let's figure out who those people are and let's try and do more. You've seen names like Nokia, Ericsson as part of a attempt to build up their own AI.
You spoke about the energy space. I think the energy trade is also the biggest way to de-risk the portfolio with the geopolitical tensions because, energy prices have shot up. The earnings, S&P has spectacular earnings growth, but if you look at the energy space, that has really dominated.
Right.
So having the geopolitical tensions, and we were talking about this before the show, is something that we have to deal with going forward. What is the best way for our clients to be able to hedge against that is to have energy exposure in the portfolio. So companies like Chevron, companies like Exxon, or you have a SPDR XLE ETF, which gives you that broad exposure. That's a really good way to add a de-risking element to the geopolitical tension.
So what do we think about the geopolitical tensions? Because do we think we're closer to the end? Do we think we're nowhere near the end? 2 weeks ago, they told us, we had a deal any day, any day. This morning, we're not anywhere near a deal, especially over the weekend. They come out with the list of 6 or 7 demands that are really non-starters when you talk about kind of where it is. So where do you think we are in that whole geopolitical fight?
I think the market has sort of figured out, like initially, when the war happened, the market came down, but I think the market has sort of figured out that we can live with this.
Right.
We can live with the status quo. We can live with some uncertainty.
Right.
As long as other aspects of the economy are doing well.
Which is exactly what happened with Russia-Ukraine. Remember when that first started creating all kinds of panic? Now, weeks can go by, you don't even talk about it.
Exactly. And that's where, from our point of view, we always have those conversations where we remind people that remember about those Russia-Ukraine crisis, same thing happened. It's the same playbook. I think now the market has accepted that this is here to stay. And that is why you don't see much movement in the market based on the geopolitical tensions. Our base case is that even if this gets resolved, there could be something else. So we should be prepared for an environment where geopolitical tensions are going to be there.
Remains elevated.
Remains elevated.
Remains elevated. But let me ask you a question. Do we think that this current geopolitical situation with Tehran, Iran, and the U.S. is going to also be driven by midterm elections because they know that we're 11 weeks away or 8 weeks away from our midterm elections, and that if they don't make this deal and they don't let Trump look like he won, that's a negative for Trump, right? That the country will get exhausted. America will just say, I'm done with this. They'll vote Democrat and then they'll completely neuter him.
And I think that was the idea with the Trump administration. Like this is another thing that we were telling clients some months back is that they're going to try and resolve this because they want positive outcome in the midterm elections. But the counter side is that Iran also knows that, right? So they're playing that card as well, and now it's game on, right? And it's this back and forth, which is one day there's a deal, the other day it's not. It seems to be very frivolous.
And I think we're, with every day that passes by now, we're getting that much closer to the election, and people are just going to throw their hands up and say, I'm frustrated, I'm angry, and they're going to vote. That's how they're going to vote.
That's how they're going to vote because, their affordability is a key factor. They're feeling the pain at the pump. And, that is, now we've started seeing prices creep up as well. Again, and people are getting hurt by this, right? And at some point, they're going to say that this wasn't well thought out. And they're going to react to it and potentially...
Well, remember, it was supposed to be a 6-week conflict. It was now turned into a 7-month conflict with no real end in sight.
Right.
And you're starting to see that, right? You can hear it in... Even on the Republican side, there's starting to be more frustration.
I think one thing that's kind of much more hurtful this time around...
The resolution to the war. It's going to take time to rebuild all that infrastructure to get the supply chains going again.
Yes, but the price of oil will drop fairly quickly. Right? If there's a deal, that would be a benefit, right?
Yeah, so it should come down quickly. And I would just want to say, I think when we're talking about the geopolitical tensions, I still think Ukraine's tactical. Even what's going on in Iran's tactical. The strategic overriding is still China.
Yeah.
And I think it's China's attempt to sell their products globally. Like they shifted from being comfortable with made in China to made by China 10 years ago. BYD automobile, I probably hadn't heard of it until 2020. And now it's just in Germany, it's everywhere. And I went and checked out one of their showrooms. They're actually pretty decent looking cars. So, they're doing that. And lately,
not in a million years will I buy a Chinese car.
So
not in a million years.
There we go. I will never use Chinese compute if I can avoid it. But yet all of a sudden now we're being flooded with cheap Chinese compute
again. I
again.
tell my kids not to buy Chinese toys because they're always...
Well, but the problem is everything's made in China, right? That's the problem.
I went on Temu once. I felt dirty. I know they already have my information, but it's
I just want to say one thing about the whole oil thing and about the airlines and all that stuff is that, the story that was running around last week about how the airlines are now using AI to monitor you. When you go on JetBlue's website or Delta's website, American Airlines, they're monitoring your address. They're seeing where you live, what zip code you live in. They're monitoring things you buy, and then they're adjusting the price that you see on the site. So you might get one price, I might get a different price for the same exact flight if we go on at the same exact time because your zip code is maybe a higher end than my zip code, or you're buying you just went out and bought yourself a Mercedes and I bought a Ford. Is that they're going to look at you and say, well, this guy can pay more, so we should charge him more, right? That's an issue with AI for sure. In the airlines, it's going to be an issue with a lot of things because if you have that kind of demand pricing, it's going to happen everywhere, right? That's a whole nother conversation about AI. And so since I went there, let's just talk about where we are in the AI trade. Very much in early stages. Where do you think we're at?
So I think as far as AI is concerned, the first stage was where all these hyperscalers did extremely well.
Right.
And I think we are now in phase 2 and phase 3. And phase 2 is essentially this $800 billion that is getting spent. Who's going to receive it?
Right.
You saw Caterpillar's earning. They did extremely well.
Right.
Now this
Caterpillar's been amazing.
It's been amazing.
Well, because it's one of those adjacent stocks, right? It's not AI, but it is AI.
Exactly. And another interesting company, John Deere.
Yeah.
You know what they do? They basically, their tractors, they've implemented cameras in there which enable them to spray parts of the field that are infected by weed as opposed to the whole field.
Right. So only spraying where it's infected, not the whole thing.
Exactly. Driving cost savings for the farmers, productivity increases for the company. So now we are starting to see these type of things. We are seeing benefit AI enablers, which are the infrastructure company.
Yeah.
We are seeing AI beneficiaries, which are companies like John Deere that are implementing AI into their businesses and seeing productivity gains. So I think we are at that phase right now where the phase 1, Mag 7, underperforming the market significantly this year.
Yeah.
Phase 2 and phase 3, where the money is going, that is where we feel is the next stage.
Right. But even while the Mag 7 may be underperforming, for me, that's no reason necessarily to blow out of all my Mag 7 stocks, of which I don't own all 7, but I'm not selling my Amazon and my Apple because it might be underperforming 1 year. I'm just not. I'm taking advantage of it in other places.
But Kenny, the problem is that a lot of people, what they were doing was they were listening to the news.
Right.
And then they were just going extremely heavy in those sectors.
100%.
And now those 7 stocks are more than 30% of the S&P 500. Right. So even if you're an indexer, you're concentrated, right? And even within the Mag 7, now there's differentiation. Which one of those are monetizing AI and which one of them are not?
That's right.
You saw that.
We saw that in earnings.
And we saw that in earnings. Meta was punished. Microsoft was rewarded. So I think the key is that even within technology, you have to be, we're not saying blow out of the Mag 7, but we are saying be more, have exposure to other areas of tech.
That's right. And you can't be FOMOized, right? You can't be fear of missing out. Like you're not missing out. If you're invested and you've got your foot in the water, then you're participating. You just have to be a bit more methodical in how you allocate it.
This is a market where patience is being rewarded.
Yeah.
Right? Where, like, if you look at the cybersecurity stocks, right? They did extremely poorly in the beginning of the year.
Right.
Past 3 months, parabolic moves
taken off.
in CrowdStrike, Palo Alto. Patience is being rewarded. So if you wait, and you could do the same thing with semiconductors. Fact of the matter is the semiconductors have shot up so quickly that a lot of people missed out on that completely. Right? And it became such a large proportion of the S&P 500 in a very short period of time. But you continuously keep getting pullbacks in that sector. You got it last year, you're getting it this year.
Yep.
That's when you dip your toes.
That's right.
And you get involved.
Agreed. You're not chasing it when they're at their highs. You're going to take advantage. You have to be ready to take advantage when you see that pullback happen. Because the pullback can happen fairly quickly, right? Because with the technology allows you, one day suddenly you turn around and it's all up 10%. Like, how'd that happen?
Exactly.
Right?
And you saw that with SpaceX.
Yeah.
Right? SpaceX shot up.
Yeah.
Meta playbook shot down.
Yeah.
If you wanted to nibble at it, you might as well do it at 120
I
as
didn't
opposed
nibble.
to...
I was waiting for it to go to below 100. I was waiting. Still might get there.
Limit orders?
Yeah. All right, listen, let's talk about the bond market just real quick because we're going to run out of time here. Is that the bond market and Kevin Warsh? Good job, bad job so far? I know it's only been, what's he been, 2 months or 3 months he's been in that position. Give me your sense. I like Kevin Warsh. Yeah. Give me your sense of what you think.
Yeah, I like him too. I think it's decent. I think reality is we will, as far as rates are concerned, I think we'll probably remain unchanged for the rest of the year.
Yeah.
I think it's interesting that money markets now, after you take out taxes, the net return is not beating inflation. Right. So I think that for that reason, investors are well served in trying to lock in high yields by going for bonds. So I think overall it's a decent job. Fed will probably stay put for the rest of the year.
Is now the time to fall in love with bonds?
I don't know. One thing that which I agree with Warsh is that AI productivity is going to bring prices down. Right. That is going to be deflationary. And we spoke about John Deere, right? So these are the things that we'll probably see which will actually be helpful. And it takes a little bit of time for those things to play out, right? It's the second and the third phase. Right. And that'll be interesting to see how that plays out.
Right. And inflation was coming down.
At the time. I've appreciated this conversation. Maybe we'll circle back in 3 or 4 months to see how this all panned out. Until the next time, take good care.